Hi friends, welcome to our Tax TV channel. Transfer pricing. Why should small and medium-sized enterprises, SMEs, care? Transfer pricing (TP) is a tax concept where companies operating within a group are required to transact with one another at market prices, also known as arm's length transactions. In short, such transactions should be similar to how independent companies transact with one another. In the course of carrying out their business activities, many companies inevitably enter into intra-group transactions, or related party transactions, whether it is the buying or selling of goods or services. Hence, taxpayers must manage transfer pricing risks carefully as there are various business, reputational and financial implications involved. Globally, many countries have introduced various measures with the aim of mitigating and preventing tax leakages as well as ensuring that profits are taxed in line with value creation, that is, to prevent profit shifting from one tax jurisdiction to another. Correspondingly, many countries have mandated the need for companies to prepare transfer pricing documentation, TPD. According to the Organization for Economic Cooperation and Development (OECD's) website, a total of 73 countries have TP legislations in place as at June 2022. The documentation needs to be maintained on an annual basis and should be ready by the time that the company files its tax return for the year of assessment, typically 7 months after the financial year end.
For example, let us now look at a few key points which are important for SMEs to take note of when it comes to compliance to TP rules in Malaysia. 1. No exemptions from preparation of TPDs for SMEs. To ease the burden of taxpayers, the Malaysian TP guidelines sets out thresholds to differentiate between when taxpayers are required to prepare full TPD, and when the taxpayer has the option to prepare limited TPD instead. Companies which record gross income exceeding 25 million Malaysian ringgit and total amount of related party transactions exceeding 15 million Malaysian ringgit or provide financial assistance to related parties where the financial assistance exceeds 50 million Malaysian ringgit other than financial institutions are required to prepare full TPD. This, however, does not exempt SMEs from the preparation of the TPD as there are currently no exemptions or concessions provided for SMEs. As such, SMEs essentially face the same TP risks as larger taxpayers. In short, as long as a company enters into related party transactions, the company is required to prepare TPD in Malaysia.
2. TP rules apply to all related party transactions. The Malaysian TP rules do not provide any exemptions or exclusions for companies which only enter into transactions with related parties within Malaysia, domestic related party transactions. In relation to preparation of TPD as such, companies would still be required to prepare TPDs even if they solely engage in domestic related party transactions. Similarly, even if the company is merely the recipient of goods or services supplied by its foreign and/or domestic related parties, a TPD would still be required to be prepared by the company.
3. Risk of TP adjustments. Based on Malaysian TP rules, companies are required to prepare TPD to demonstrate the arm's length nature of such transactions. The IRB may make TP adjustments in the event that the IRB views the transactions as not meeting the arm's length requirement. This in turn may result in additional tax payable by the company. As an example, a product sold to a group company for 5 lakh Malaysian ringgit may not be considered as meeting the arm's length requirement when the same product is sold to a third party for 1 million Malaysian ringgit. The IRB may seek to uplift the company's revenue in this respect. Similarly, companies which acquire intercompany services but are unable to demonstrate benefits received from these services are exposed to higher risk of TP adjustments during an audit.
4. Introduction of surcharge and penalty for failure to furnish transfer pricing documentation. In the past, penalties were tied to additional tax payable. Hence, many taxpayers which are not in tax payable positions, Example companies which are granted tax incentives, loss-making companies, etc. generally focus less on the preparation of TPD, given that TP adjustments proposed by the IRB would not give rise to additional tax payable. However, with effect from January 1, 2021, a surcharge on TP adjustments was introduced. The surcharge can be applied up to 5% of TP adjustments, whether or not the company is in a taxable or non-taxable position. In addition, to facilitate a greater level of compliance amongst taxpayers, a penalty for failure to furnish TPD upon request by the IRB was introduced. Based on the TP guidelines, the taxpayer is required to submit the TPD within 14 days of the request. Companies which fail to submit the TPD within the timeline may be subject to fines of between 20,000 Malaysian ringgit to 1 lakh Malaysian ringgit. This penalty also came into effect from January 1, 2021 onwards. Given the ever-evolving TP landscape within Malaysia as well as globally, it is imperative that SMEs increase their awareness with respect to TP matters in order to better manage and mitigate their TP risks.
Contact Online Tax Specialist 22@gmail.com for online preparation of TP study or documentation. Website www.onlinetaxspecialist.com